Reverse charge. Now let's have a look into reverse charge in GST taxation in India. Now GST is on what? Sale of goods, rendering of services. Instead we can say outward supply of goods services. Instead we can say forward transaction. So whether we tell forward transaction or outward supply of goods services, sale of goods, rendering of services, we can say any of these things. So forward transaction, sale of goods or rendering of services, outward supply of goods and services, goods or services, what is applicable? And that what is applicable is forward charge. So by default, in general, GST levied in supply of goods services is forward charge only. By default, whenever we are referring GST levied, we are referring to a forward charge. That is a forward transaction, outward supply of goods or services. Now, what is this reverse charge? Reverse charge, when it will arise? Reverse charge is levied only in specific situations as specified in specific provisions in Act or any notification. Reverse charge is levied only in specific situations as specified in specific provisions. It may be in Act, notification, something like that. Now, forward charge is applicable on what? On a forward transaction, whereas reverse charge is applicable on inward transaction, inward supply of goods and services. Inward transaction we may use, inward supply of goods and services we may use, purchase of goods or consumption receipt of services we may use. Purchase of goods, consumption receipt of services, inward supply of goods or services, inward transaction. Here we are referring to inward transaction or inward supply of goods. So forward charge is basically on outward supply, whereas reverse charge is basically on inward supply. Now let us take some examples. Now reverse charge, can it be levied just like that? Unless expressed by express provisions, RC cannot be implied. So if there are specific provisions in Act, notification, then only reverse charge is applicable in specific situations. Now let us take some examples. Stage 1 sale. Let's assume the person is a RD, registered dealer. He is seller 1. Sale value is 100 rupees. Not sale value, 100 rupees is the sale exclusive of tax. Then tax thereon 18%. 118 is the sale value including tax. Without tax it is 100, 18 rupees tax, with tax is 118. Now RD seller 1, what he will do? He will remit 18 rupees to government. So is it forward charge or reverse charge? By default it is forward charge, because unless specified, unless only in specific circumstances and situations specified in specific provisions, RC will come. Otherwise, by default, in general, whenever we speak about GST, we are talking about forward charge. So, registered dealer 1, seller 1, 118 is the sale value including tax. GST remitted is 18. Simple. Next, stage 2 sale. Registered dealer, that person is also a registered dealer. He is the seller 2, that is stage 2. The same goods are going via stage 2 sale by seller 2. Let's have a look into profit and loss account or income statement of the profit and loss statement or income statement of seller 2. Now, sale happening at 250 rupees. Now, in that, GST is 18%. So, without tax, sale value is 205. With tax, with GST, it is 250. Sale value without GST is 205. And 45 is the tax component, 250 is the sale value. This is case 1. We are talking about case 1. Now, we are looking into expenses, that is purchases. So, revenues, that is receipts and payments, revenues and expenditure. So, revenues are 250 rupees that we have discussed, that we have seen. Then purchases is 118. Seller 2 has purchased from seller 1 previous sale at 118. Seller 2 has purchased from seller 1 at 118. Now, purchase 118 with GST. Without GST, 100 rupees, 18 rupees, that is there. GST 118. Now, with GST, purchase from a registered dealer. Seller 2 has purchased from a registered dealer in stage 1. Now, we are discussing stage 2. Now, seller 2 is selling at 250 rupees. Now, 250 with tax, 118 with tax. Then GST remitted, that is debited to P&L account. GST remitted 27. How 27? 45. 45 is the GST on output. On input, the seller 2 has paid 18 rupees. So 45 minus 18, output tax minus input tax. Net 27 he will pay to the government. That's it. So 27 is remitted to the government. Now what is the accounting profit? Accounting profit is 105. So sale value is 250 with tax, minus purchase value with tax 118, minus GST remitted by seller 2 27. So accounting profit left with seller 2 is 105. The goods are consumed, used by the final consumer at the price of 250 with GST of 45. So final consumer, here there are only two stage of sales, stage 1, stage 2. Stage 2 seller 2 will sell it to the final consumer, and final consumer has paid the price of 250 rupees. So in that, GST component is 45. This is, now let us see the revenue to the government. Revenue to government of India is GST collection 45. And how 45 has come to the government? Stage 1 seller 1, that is registered dealer RD, has remitted 18 rupees. Then stage 2 seller registered dealer has remitted 27. So total remitted to government is 45. That is the revenue for the government, GST. It has collected from two parties. Stage 1 seller 18 rupees, stage 2 seller 27 rupees, total collected 45. See, all this is normal, as usual. Now let us take case 2. Now let us take an example of case 2, unregistered dealer. He is not registered under GST. So question of collection and paying to the government GST does not arise. He is not registered under GST at all. Okay, now that unregistered dealer will sell at 100 rupees. How much GST will collect? GST is not applicable. So GST collected 0, paid to the government 0. So GST remitted 0. What is the sale value? With tax, without tax, it is without tax, with tax, it is same, that is 100. There is no GST here. Why? Unregistered dealer. We are talking about case 2. Now, let us go on to stage 2 sale. Stage 2. We are talking in case 2, stage 2. Case 2, stage 2. Registered dealer, seller 2. Let's have a look into credit side, that is P&L account. Revenues. He is selling at 250 rupees, same price. Now, in that 45 is the GST component and 205 is the sale value without tax. So, without GST it is 205, with GST 250 sale. Now, let us look into debit side or expenses in the income statement or profit and loss statement. Profit and loss account or income statement. Now, purchases. In this case 2 also, seller 2 has purchased from seller 1, that is stage 1 seller, at 118 or 100. If you observe, URD, unregistered dealer, that is stage 1 seller, has sold the goods at 100. But in P&L account, seller 2, we are recording the purchase at 118. How? Purchase 100, GST at the rate of 18%, that is reverse charge. GST at the rate of 18%, that is reverse charge. In this case, stage 2 seller has purchased from unregistered dealer without GST. But he is paying to the government 18% GST on the purchase value as usual, as if he had purchased from a registered dealer. that is reverse charge. See, normally you levy GST on sale. You collect from the customer and pay to the government. That is forward charge. Here, GST is levied on purchase, inward transaction. Even though stage 1 seller is an unregistered dealer, even though the unregistered dealer has not collected tax, stage 2 seller has to pay 18% on the purchase of goods and remit it to the government. That is reverse charge. Reverse charge is a charge on inward transaction purchases, receipt of services or purchase of goods. It's on an inward transaction or inward supply. Here, it is deemed or treated as if stage 2 seller 2, it is treated as if he has purchased from an registered dealer. See, if you look into profit and loss account or income statement, in case 1, income statement in case 1, seller 1 would have collected 18% because he is a RD, registered dealer. That is case 1. Okay. Now, so in P&L account of seller 2, we would have recorded it at 18% on purchase. For seller 1, it is on sale, and for input credit, we would have debited to P&L account, or we would have recorded in income statement in seller 2's case. So, even if the purchase in case 2, now we are talking about case 2, even if the purchase, stage 2 seller, even if the purchase is done from unregistered dealer in case 2, seller credit, stage 2 seller 2 himself will pay tax on purchase to the government. That is reverse charge. As if he had purchased from a registered dealer. In reality, he has purchased, stage 2 seller in reality has purchased from unregistered dealer, URD. But it is deemed as if he has purchased from a registered dealer, RD. So reverse charge is levied on inward transaction, reverse charge is levied on purchase, and stage 2 seller will remit it to the government. So let us see accounting profit. GST remitted is how much? GST remitted in the name of reverse charge 18. Then GST, final GST remitted. Total GST on sale value is how much? Stage 2 seller is selling at 250. In that 45 is the GST component. Now in that 45, entire 45 will remit? No. Already has paid reverse charge 18 rupees. That he will take a input credit. So 45 minus 80, 45 minus 18, 27 will remit. So total GST remitted is 45. So initially you would have paid 18, then he will pay balance 27, that is 45 minus 18. Output tax, GST on output is 45 on sale. GST on input is 18, that is reverse charge in this example, case 2. So balance 27 he will pay. So 18 is reverse charge here, 27 is forward charge. 27 is levied on forward transaction by seller 2, whereas 18 is levied on inward transaction by seller 2. Both are paid by seller 2 only. So accounting profit here also it is same. That is 250 is the sale value with tax. So case 2, let's have a look into accounting profit. So sale value with tax is 250. Purchase value with tax, that is reverse charge of 18 included, 118. Then GST remitted, that is 45 minus 18, that will come to 27. So 250 minus 118 minus 27, accounting profit left with stage 2 seller is 105. Now, is there any difference between accounting profit in case 1 and case 2? Accounting profit in case 1 is 105. Accounting profit in case 2 is also 105 only. Now, the goods are consumed, used by the final consumer at the price of 250. In case 2 also it is consumed at the same price 250 with GST of 45. What is the revenue to the government? Revenue to government is 45. GST remitted by seller 1, that is stage 1 seller, 0. Why? He is an unregistered dealer. Then GST remitted by stage 2 seller. How much is that? In the name of reverse charge, 18 on inward transaction, that is purchase. In the name of forward charge, that is 27, that is outward transaction. So total remitted to the government is 45. So revenue received by the government is 45. The only difference between case 1 and case 2, in case 1, revenue received from seller 1 is 18, seller 2 is 27. So total is 45. Two parties it is collecting, because both of them are registered dealers. Stage 1 seller, RD, registered dealer. Stage 2 seller, RD, registered dealer. Whereas in case 2, now we are talking about case 2. Government has collected the same amount, 45. But difference is from unregistered dealer, that is stage 1 seller, amount collected is 0. From registered dealer, stage 2 seller, amount collected is 45. It is collected from only one party in this example. Now, let us proceed further. Let us take up case 3. So, in case 2, right now we are talking about case 3. In case 2, if reverse charge was not there, what will happen? Why reverse charge? Suppose reverse charge is not there, what will happen? Let's have a look into it. So, we are talking about case 3. So, where seller 1, stage 1 seller is a URD, unregistered dealer. Done. So, he will sell without tax at 100. GST not applicable. GST remittance not applicable. Now, seller 2, let us look into profit and loss account or income statement. He is selling at 250. In that 45 is GST component, 205 is without GST. Debit side of P&L account or expenses of revenue statement or income statement. Now, or income and expenditure statement, whatever you want to call P&L account, purchase is 100, GST is 0. In the case 3, we are presuming that there is no reverse charge. There is no specific provision, there is no specific section. Reverse charge cannot be levied, so reverse charge is not there. Case 2, case 3, what is the difference? Case 2, we have a reverse charge. Case 3, we are not having a reverse charge. What happens if? So, first stage 1 seller is a unregistered dealer. So, he will sell at 100 without tax, without GST. Now, so we are looking at stage 2 seller, revenue received, that is sale value is 250 with GST, purchase is 100 without tax. There is no registered, there is no reverse charge also. Purchase is 100 without GST, purchase from unregistered dealer. Now GST remitted to the government, one single shot, that is 45, that is forward charge. There is no reverse charge because there is no specific provision assuming forward charge 45 will pay. That is 45 rupees on output that you will pay. On input, tax is 0. On input, tax is 0. So GST remitted is 45. Done. Accounting profit. Let's have a look into accounting profit. 250 is the sale price with GST. So purchase value is 100. GST remitted is how much? 45. So accounting profit is 105. So even if reverse charge is not there, accounting profit is still coming to 105 only. 250 is the sale value, 100 is the purchase price, 45 remitted GST, GST remitted 45, accounting profit is coming same, 105. The goods are consumed, used by the final consumer at the price of same price, 250, GST 45. Now revenue to the government, it is 45 only. GST remitted is 0 because unregistered dealer say how revenue would have been collected by the government. Seller 1, that is stage 1 seller, has not paid any, has not remitted any GST because he is a unregistered dealer, URD. And GST remitted 45 by the second stage 2 seller. So government has collected revenue of how much? 45. From the stage 1 seller 0, from stage 2 seller 45. So from the angle of government, revenue collected is 45. Then why reverse charge? For the trader 2, see, for stage 1 seller it doesn't make a difference. Reverse charge, forward charge, all that is not there because he is unregistered dealer. FC, RC, nothing will apply. He is least bothered. Now stage 2 seller, even for consumer also it doesn't matter because consumer has paid, final consumer has purchased the product at what price? 250 rupees. In that 45 is the GST. So whether there is forward charge, whether there is reverse charge in each stage of sale, it really doesn't matter for the consumer because for consumer he has paid 250 rupees including GST of 45. That's it. So for stage 1 seller, FC, RC doesn't make a difference. For consumer, it doesn't make a difference. For government, accounting profit. Now let us take accounting profit of stage 2 seller. Stage 2 seller, whether it is FC, whether it is RC, accounting profit is it same? Accounting profit is also same. Then for government, what is the revenue collected? 45. Whether it is FC, RC, this is that, how much is the revenue collected? 45. Then what is the use of levying reverse charge? Why reverse charge? Why RC, reverse charge? Now let us have a look into certain situations. What if RD seller 2 is not able to sell the goods for 1 year, 2 years, 10 years, or sells after very long time? So there are two stages of sale. Each stage of sale, normally GST revenue will come to government. Each stage of sale, normally GST revenue will come to the government. Now, let us assume a situation wherein seller 2, that is stage 2 seller, is not able to sell the goods for 1 year, 2 years, 10 years, or sells the goods after very long time. What happens in that case? GST revenue collection is postponed for the government to the extent of GST revenue on stage 1 sale. See, whether there is RC, whether there is FC, this, that, whatever, government is getting 45. But the point is, by levying reverse charge, wherever there are cases of postponement of GST collection, that will be taken care. In our example, seller 2 is not able to sell the goods for 1 year, 2 years, 10 years, or sells the goods after 10 years. Then in that case, no doubt revenue of 45 will come to the government, but to the extent of 18 rupees. To the extent of rupees 18. That is on first stage, stage 1 sale. Stage 1 sale. That is postponed to government until second seller sells the goods. So to avoid such situations, government has levied reverse charge. So to at least to the extent of stage 1 sale, which is deemed as if sold by a registered dealer in our example, that 18 comes to the government early, as if normally he has purchased and normally is on the purchase amount has come to the government. Normally means as if he has purchased from a registered dealer and registered dealer has remitted 18 rupees to the government. It is treated as if unregistered dealer, same scenario, instead of unregistered dealer, stage 2 seller will make the payment on the purchase, that is reverse charge. What happens in the total amount of 45, that 18 rupees will come to the government treasury at the time of purchase by second seller. That is the intention. So postponement of revenue to the extent of 18 rupees is not there. Let us take another example. What if seller 2 is not able to sell the goods at all? Why? They have become obsolete or past expiry date. Now what? In that case, GST revenue collection is lost for the government to the extent of GST revenue on stage 1 sale, deeming stage 1 seller is a RD. See, let us take another example where seller 2 has purchased the goods. Now, after some time, they have become obsolete or past expiry date. He is not able to sell the goods at all. Now, here there are two stages of sale. Each stage of sale, GST revenue arises to the government. Now, even though seller 2 has purchased from unregistered dealer URD, it is deemed as if he has purchased from RD. And 18 rupees, if it is collected by the government in the name of reverse charge, that 18 rupees will reach the government treasury. Suppose reverse charge is not levied, what happens? the seller, that stage 2 seller, will not be able to sell obsolete goods or goods which are past expiry date. So, whatever revenue related to stage 1 sale, that is rupees 18, whatever revenue related to stage 1 sale, rupees 18, stage 1 sale, that is lost to the government. To avoid such a situation, reverse charge is levied and collected. See, on the face of it, prima facie observation, from the angle of seller 2, accounting profit is same, 105. Whether reverse charge is levied, whether reverse charge is not levied. On prima facie, if for government, revenue collection is same, 45. Whether reverse charge is levied, whether reverse charge is not levied, it is same. But the difference is, in the situations which we took an example, in one case, revenue might have been postponed, GST revenue collection. In another case, GST revenue would have been lost to the extent of GST relating to stage 1 sale. Hence, reverse charge is levied in certain situations specified by specific provisions. So, unless there is a specific provision, reverse charge will not be levied. So, whichever country it is, specific provisions will be there to levy reverse charge. It's a global, levying reverse charge is a global practice. GST is there in many countries, and levying reverse charge is also a global practice. Thank you.